Welcome back to Investing Talk Podcast. Today, we are zeroing in on a ticker that has, well, fascinated and frustrated the market in equal measure. Beyond Meat. This company really represents the ultimate high wire act, doesn't it? Fallen from these massive valuation peaks to now plumbing severe lows. Our mission today is pretty straightforward. We're digging into the sources, the hard financials, the technical collapse, the analyst confusion to tackle that central question. Is Beyond Meat actually a good time to buy now? We need to understand the current operational reality and really judge if this argument for deep value with a catalyst is plausible or maybe just pure fantasy.
That's exactly the split. You see a stock trading this low, and the immediate thought is often value trap.
Yeah.
And, to overcome that, you need some really undeniable evidence. Evidence that the underlying assets, and we're talking primarily the globally recognized brand, are worth way, way more than the current equity price. Plus, you need a clear path, a credible one, back to profitability. We absolutely have to look past the plant-based aspirational hype and focus relentlessly on the numbers. And critically, let's be honest, the existential risks involved in putting capital here.
Right. Before we break down the source stack, just a quick note to you, the listener. We curate these explorations based on what you want to learn about. So please subscribe, like, and comment. If you have a specific company or maybe a set of sources you want us to look into next time, just leave a comment below. We really are listening. Okay, now let's begin with the cold, hard financial reality.
The financials, well, they tell a story of strategic retreat, really.
They certainly do. If we look at the big picture, the revenue, trailing 12 months revenue is sitting at $301.35 million. Now, the full year 2024 revenue was higher, $326.45 million, but critically, that marks a 4.9% decline year over year from 2023. So the top line is shrinking. And that's even before we get to the cash burn.
Exactly. And that shrinking top line might be manageable if,
Yeah.
if they had strong margins, but they just don't. Historically, the strategy was growth at all costs, right? Profitability wasn't the main focus.
Yeah.
Now, the big shift you see in the sources is this focus on survival. For the trailing 12 months, the net loss was still substantial. We're talking negative $153.60 million. But you have to put that into context. Their loss in 2023, a staggering $338.12 million.
Wow, okay. That reduction is significant, though. You're talking about cutting the cash bleed by more than half year over year?
Precisely. And this isn't just, minor belt-tightening. The sources clearly show this is a necessary strategic pivot, pure cash preservation mode. Management seems to have realized they just can't achieve the scale needed to support their old cost structure. So they're restructuring for survival. That pivot, I think, is the single most important operational insight from the recent financials.
But the core profitability issue, it still remains, right? Profit margins are still deeply negative. Management targets improving gross margin towards 20% in 2025. That's the stated goal. But recent results were hovering, about 4 percentage points short of that goal? They're closing the gap, maybe, but they aren't there yet.
And that struggle, it directly informs their future outlook. The projection for net revenue growth in 2025 is, modest. It ranges between negative 2% and positive 3%. That expectation really confirms the focus is entirely on stabilizing the ship, hitting those strict cost controls, not pursuing aggressive expansion, especially in this difficult consumer environment. For their financial health to stabilize, really they have no choice but to hit those internal margin targets, almost regardless of revenue.
Okay, so when we talk about stabilization, we have to look at the current valuation. It's, profoundly discounted. The market capitalization is currently sitting at only $49.55 million. That figure alone should give every investor pause.
It really should. And when you compare that, $49.55 million to the size of their established manufacturing infrastructure, their global IP portfolio, and just the sheer cost of building the brand recognition they currently have, it suggests a profound undervaluation if, and it's a big if, they can survive the next, say, 18 months. What's concerning, though, is the tight liquidity. Free cash flow is still deeply negative, and while current assets do slightly edge out liabilities, those ongoing net losses mean they have a very limited runway. They're essentially operating without a safety net right now.
Yeah, that lack of a safety net brings us directly to their competitive standing. If the financial engine is struggling this much, what assets or what moat are left to protect that tiny $49.55 million valuation from just collapsing entirely?
Well, the sources are pretty clear on this. The primary asset is that sort of untouchable first mover status and strong global brand awareness. Beyond Meat is still one of the world's most recognizable names in plant protein, no question. They've achieved distribution across every major channel: retail, food service, mass merchandise on a global scale. That network, that shelf presence, it took hundreds of millions of dollars to build, and they still own it.
And the sources also emphasize their commitment to innovation, right? Like,
Yeah.
this is their way of saying they aren't just static, even while cutting costs.
Exactly. They maintain a high innovation cadence, constantly pushing R&D, launching new product iterations, like their recent beef and steak alternatives. This is actually a critical positioning asset. If the macro trends, consumer concern over climate or health, if they swing back strongly toward alternative proteins, Beyond Meat is immediately positioned to capitalize because of that established brand and product pipeline.
But innovation costs money, and as you said, they're facing immense headwinds. What are the key competitive risks highlighted in the sources? The things that could undermine this moat?
Right. Well, the sector is fiercely competitive. That's the first thing. And the main threat is pricing. The initial sort of enthusiasm for premium plant-based products, that seems to have waned, which leads to severe pricing pressure across the board. And maybe more importantly, you have the looming threat of the giant established food processors, players like Tyson or JBS. They're accelerating their own private label or house plant-based offerings, and they have the distribution scale, the capital depth. They could potentially undercut Beyond Meat's margins indefinitely.
Okay, so given those giants entering the fray, do the sources suggest Beyond Meat has clearly lost market leadership? Is it over?
Not definitively, no. While competition is fierce, and yeah, they've lost market share in specific segments, the brand equity and their existing intellectual property seem robust enough that they're not yet, written off. The consensus seems to be that the brand itself constitutes a notable moat, even if the current operation is struggling to leverage it profitably.
Okay. So if liquidity is tight and the operations are precarious, market sentiment should reflect that panic. Let's move to the technical picture, because this is where the volatility trade becomes really striking. The recent closing price, as of October 17th, was just $0.65 per share. 65 cents.
Yeah, and to really appreciate the depth of that collapse, you just have to look at the 52-week range. It stretches from a low of 50 cents all the way up to $6.64. This total 65 price reflects a just staggering depreciation, a true collapse in value. It indicates severe investor fear and, frankly, low institutional conviction.
And when we look at the technical indicators, the stock is just screaming distress. It sits well below the 50-day simple moving average of $2.34 and drastically below the 200-day average of $3.07. It is, by definition, deeply oversold.
Deeply oversold, absolutely, but also intensely volatile. The measured volatility sits extremely high at 32.83%. And this isn't an accident. This volatility profile is exactly why certain types of high-risk hedge funds and short-term traders are attracted to this stock. They thrive on these sharp, quick swings driven by news, rumors, or perhaps most relevantly here, the analyst ratings.
And here's the narrative hook that really demands our attention, the analyst disconnect. The consensus rating on this stock is a strong sell. The analysts are bearish. 6 sell ratings, 2 hold, 0 buys. Clear signal, right? Yet when you average their price targets, the consensus 12-month target is $2.27.
Right. Stop and think about that implication for a second. Stock trades at 65 cents. Consensus target, $2.27. That implies a staggering 251% potential upside from the current price. This isn't just a cautious signal. This is the market acknowledging that while the current operations are, frankly, terrible, hence the strong sell, the potential reward if the company executes a turnaround or maybe gets acquired is massive. It just reveals this high-stakes, low-conviction environment.
Okay, so the stage is set for extreme moves, and we just saw a massive destabilizing shock hit the company in October 2025 that increased the risk profile even further.
That's the supply dynamic issue, yeah. We're talking about the major lockup expiry. This event allowed approximately 316 million previously restricted shares held by early investors, employees, maybe venture capital funds, to hit the open market. Now, this wasn't a secondary stock offering adding dilution, understand? But it massively increased the free float, and that drove unpredictable trading moves, creating huge selling pressure as those locked up shareholders took profits or maybe just reduced risk at the first chance they got.
Okay, so we have a supply glut hitting a stock that's already technically oversold and facing, well, an existential crisis. The next major event on the calendar, Q3 2025 earnings scheduled for November 5th, becomes absolutely critical then.
It really is a binary moment, I think. Management has to deliver on their promise of stabilization and cost controls. They need to provide updated guidance that shows consistent progress toward margin improvement, and most importantly, clarity on their liquidity status, especially after that recent share unlock event. Any disappointment will likely trigger rapid downside movement, capitalizing on that huge supply overhang.
What about the long shot catalyst, the constant speculative buzz around M&A? Is that a real option or just market noise?
It's a recurring, and I'd say credible, rumor, primarily because of that depressed valuation we talked about. Rumors periodically circulate about potential strategic buyers or maybe more realistically, private equity interest. I mean, when a global brand with established infrastructure and IP is trading for under $50 million, it presents itself as a potential distressed asset purchase. A buyer could potentially acquire the brand, strip out the operational cost, and maybe relaunch the product portfolio with a different, lower-cost strategy. Okay, that said, if M&A is the long shot, what's the core immediate risk? What keeps people up at night here? Liquidity risk. It remains elevated. We really can't stress this enough. They are burning cash, yes, albeit at a reduced rate now. But if the revenue outlook and those margin targets disappoint significantly, further dilution through debt or issuing more shares might be necessary just to sustain operations. The combination of ongoing net losses and this recently increased share float creates intense pressure. It makes every quarterly report a fight for survival.
We should probably quickly mention a couple of other technical dates coming up, too. Things that could force action from institutional holders, regardless of fundamentals, like the ETF and index rebalancing event scheduled for November 15th, and the 13F deadlines for institutional holdings in mid-December.
Yeah, those are important timing signals for the listener to be aware of. These events can force institutional funds to either buy or sell based purely on technical criteria, not necessarily fundamental improvements. And that can lead to potentially artificial high-volume trading volatility in the short term.
Okay, so what does this all mean for you, the listener, considering a position here? Let's try and synthesize the investment thesis. Beyond Meat is a brand powerhouse, no doubt, trading at a fraction of its former value, but facing severe operational headwinds and undeniable liquidity risk.
Right. And the sources, interestingly, land on an overall bullish rating of 7 and 10.
Wait, a 7 out of 10 bullish? That seems counterintuitive, doesn't it?
Yeah.
The financial story screams existential crisis. The technical picture is one of panic. What anchor in these sources is preventing, like a 310 or a 410 rating? That 710 suggests a calculated risk, not just a pure gamble.
It is calculated, yes, but strictly for those with very high risk tolerance. Let's be clear on that. The 710 rating really hinges on the potential payoff due to that extreme brand versus valuation disconnect. The rationale rests on 3 very specific pillars, and they're not necessarily tied to successful execution next quarter. First, deep value positioning. The undeniable value of the brand, the distribution, the IP, it's just not reflected in that $49.55 million market cap. Second, event-driven upside. The high volatility means any small positive news or rumor, successful cost-cutting, even just surprisingly stable revenue could trigger massive short covering and quick gains. And third, long-term optionality. This is the explicit bet on either a strategic acquisition or a successful structural industry recovery that validates their IP investment down the line.
So the thesis is essentially you're not really investing in the current management team's ability to turn a profit next year. You're investing in the possibility that someone else recognizes the brand value before the company runs out of cash.
Precisely. That's a good way to put it. The analysis suggests 2 main investment horizons. Either high-conviction short-term trading, trying to exploit the Q4 2025 event volatility we discussed, or speculative long-term positioning, where you are truly betting on that successful turnaround or, more likely perhaps, an individual strategic buyout. This is really a speculative asset trade based on brand equity, not an investment based on current operating cash flow.
Okay. The sources lay out a very clear trade-off for you. The immense global brand equity of Beyond Meat is currently valued at less than $50 million, yet the execution risk has probably never been higher. So, given the massive share unlock and that critical November 5th earnings call looming, let's leave you with this provocative thought. Is the price low enough now that a strategic buyer, say a massive global food company or a private equity group, sees the brand equity itself as a deeply distressed asset worth acquiring, even if they immediately plan to shutter, say, 80% of the current operational structure? Is the acquisition play now the only realistic play left? Something to consider as you watch the charts. Thank you for tuning into this exploration of the sources on Beyond Meat. We hope this analysis helps you navigate the complex world of investing.